Today we're going to discuss some of the key takeaways from the book A Random Walk Down Wall Street. I'll talk about the main overarching theory in the book, as well as some of the actionable points of advice that the author gives. People's opinion of this book widely varies. If you are a day trader, you probably hate this book. If you are a long-term investor, you probably either like or love this book. A lot of these finance and investing books can be extremely verbose to basically get to a really simple conclusion. So we're going to jump right into the main overarching theory of this book, a random walk theory. Basically, the author of A Random Walk Down Wall Street believes that the market cannot be predicted. It cannot be predicted by past movement, and there's no way to tell what it will do in the future. This is the book that brought up the concept that a monkey throwing the dart could predict stock trends just as well as any so-called experts. He believes that stock prices are totally independent of anything else, and so by saying this, he's basically shooting down technical analysis, market timing, and even fundamental analysis. So his reasoning with these is that with technical analysis, and if you are trying to time the market, a lot of this is just based on patterns and human psychology, and he argues that as more and more people catch on to these patterns, then it becomes easier for these patterns and trends to actually break themselves. So one of the examples that he gives is everyone trying to buy stocks in late December and sell them in the first week of January when the markets are really moving. Eventually, as more and more people catch on to this, you would have to start buying even earlier in December and selling even earlier in January to beat all of the other people to it who are trying to jump onto this trend or this pattern. He points out that that can pretty much apply to anything. And his argument against fundamental analysis is that you don't necessarily always know that the data that these companies are presenting is totally accurate. And he also points out that in some industries and with some businesses in particular, it's hard to actually predict what their fundamental value will be later out into the future, especially with things like emerging technology and just these new concepts and ideas that we haven't really had before. It's hard to put a value on those companies. Again, this is the author's opinion on these things. I'm sure that Warren Buffett and Cathie Wood would likely disagree with a lot of this. So honestly, that's the majority of the book, is just this idea that the market is random and that stock prices are random. It isn't until the last chapter or so of the book that the author actually gives you actionable steps that you can take to get your own finances in order. So that is what we're going to talk about now. There are 10 tips that the author gives, and the first one is to have protection set up for yourself. So he really means two things when he's talking about this. First, he talks about setting up a regular savings program for yourself. So always setting aside a certain amount of money that you are saving towards your future that you don't touch for any other reason. He also briefly talks about having insurance for protection. So this could be either actually buying life insurance, or he even talks about just having your own investments or a combination of both. The second tip that he has is to determine your own investing objectives. So he, several times throughout the book, mentions that when you are investing, you are either going to be able to eat well or to sleep well. And he gives this scenario of a guy who is telling his friend about his investments, and he's like, oh my gosh, I can't sleep at night because I'm so worried about my investments. What do I do? And that other friend suggests that he should be investing enough that he can sleep well at night, but not investing so much of what he has that he's staying up worrying about what could go wrong. So basically the point that he's trying to make is that there's always a balance with how much you should personally be investing, and what you're comfortable with investing or investing in is going to vary from person to person. The third tip that he gives is to dodge Uncle Sam whenever you can. And he's not talking about tax evasion because that's definitely illegal. What he's talking about is to use these different account types, these different investing accounts, to your advantage. So there are different types of IRAs, there are even college savings plans, and even a Roth IRA, and each one serves a slightly different purpose and can benefit your tax situation in different ways. So with this third tip, he's just saying to learn about all of these and tailor those accounts towards your particular situation so that you can get the maximum amount of return out of the money that you're actually putting into these accounts. The fourth tip is to have a plan for your cash and for your shorter term goals. The key takeaway with this one is to make sure that you are letting your cash at least keep up with inflation, if not make a little bit more. So for shorter term goals where you may be saving money for a year or two, but you know that you're going to need that, he suggests looking into money market funds, into bank CDs, into tax-exempt money market funds, and he also talks about using online banks as an alternative to regular brick and mortar banks so that you get a little bit better interest rate. Part of the reason why online banks are usually able to offer a little bit better interest rate is because they don't have the overhead of those physical locations. So you could use things like Capital One 360 or Discover or Ally Bank or Novo if you have a business. And these are all banks with a little bit higher yield than you would get at somewhere like Chase or Wells Fargo. So by putting it there, you're helping your cash at least keep up a little bit with the level of inflation. The fifth tip that he has is to look into adding bonds into your portfolio. So some people love bonds, some people hate them, but he does give a list of different types of bonds that you can look at. Some have different tax advantages. So again, just seeing if those may or may not fit into your investing style. His sixth tip is to own your own home instead of renting. This is a highly divided subject, and I'll do another entire video on this, but in some cases and in some cities, it doesn't always make sense to buy instead of renting. So in my opinion, this depends on your situation, but the author thinks that you should buy your home instead of renting. The seventh tip he has is to look into REITs, or real estate investment trusts. So we've talked about this briefly in a couple of other videos, but these are basically a way for you to get into real estate investing through your investment portfolio without you having to physically own any real estate. You're essentially putting money into these little real estate funds where they own and operate the different real estate. It could be residential, it could be commercial, it could be for a specific industry like hospitals or retirement homes. So this tip that he has is just to look into those more and again, see if those are something that you would want to add to your own portfolio. The eighth tip that he has is to tiptoe through gold and different collectibles. So we've also talked about this briefly, but there are definitely ways that you can invest outside of the stock market. For some people, this is things like precious metals. For other people, it's collectibles like Pokemon cards. So number 8 is to look into these alternative investments, but to also be a little bit wary of them. The 9th tip that he gives is to watch out for commission costs. Nowadays, this isn't as much of an issue. Most brokerages are commission free, but depending on what you are investing in and your investing or trading style, there are other fees that can pop up. So revising this more for modern day, we're going to say that number 9 is just to watch out for fees and make sure that you are choosing the brokerage with the lowest fees for whatever you are trying to do. And number 10 is to diversify. So if you read through this book, you can tell that this author, his main strategy is just buy and hold ETFs, and that's pretty much it. But it does go back to those other things that he suggested. So looking into bonds, into REITs, into different things like gold and collectibles, just to spread your money around a little bit and not be totally invested all in one thing. Again, not putting all of your eggs in one basket. If you do read this book, there are many times throughout it where The Intelligent Investor is mentioned, which is another investing book. And if you want to see a summary and the key takeaways from The Intelligent Investor, click on this video and I will see you guys over there.